Good morning and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at MarketSite, we have Roy Choudhury. He's the principal of the Financial Services Advisory Group over Ernst & Young, and we are going to focus on the transition from IBOR to new indexes and how that's going to transform the global financial markets. It's great to have you back on set with me at MarketSite, and let's talk about that. That IBOR transition is going to be the new standard for global financial markets.
Indeed. Thank you for having me, firstly. So, yes, I think this has been worked on for many years, since 2013, and IBOR is going away. That's a certainty now. And alternative reference rates that have been selected across all of the G5 currencies will become the new reference rate across financial markets. So,
and why are they transitioning out of LIBOR, IBOR into these new kinds of products, and what are these products?
Sure. So LIBOR as a reference rate has been used for many years, for more than 40 years in financial markets. However, most recently, the liquidity in the interbank markets, really the markets on which IBORs are calibrated, the liquidity in that market has really dried up. I think after the financial crisis, driven by a number of reg reform agenda like LCR, NSFR, money market fund reform, these reg reform agendas have really dried up liquidity in the interbank market, and we don't expect that liquidity to come back. So increasingly you have LIBOR as a reference rate, which is not informed on the basis of transaction. More and more expert judgment is used, which obviously makes the rate more vulnerable to manipulation. So given lack of liquidity and manipulation risk, we think LIBOR is not a feasible long-term rate in financial markets. And hence they have been replaced by these alternative reference rates, which are transaction-based. They're based on deep liquid markets. In the US market, for example, SOFR has been selected. SOFR is based on US Treasury repo markets, which are more than $700 billion in transactions. So interest rates informed by deep liquid transactions in markets are a much better rate.
So it's more transparent.
It's more transparent, right. Less subject to manipulation, less use of expert judgment, and well understood.
So SOFR is what we're going to be using in the US, as you had mentioned. Are there any other competitive products, or is that going to be the gold standard, if you will?
Yeah, so I think SOFR is expected to be the gold standard. It's been informed by a working group put together by the Federal Reserve as well as the private sector. So I think there's a lot of consensus around SOFR being the right rate. The working group had spent 2+ years assessing different alternatives, and they converged on SOFR as the right rate for the market going forward. There are some competing recommendations. ICE, which is a benchmark administrator, has just come up with a competing rate to SOFR, or one may deem it to be a complementary rate. But there is significant momentum in the financial markets, both by the regulators and the private sector, to really drive liquidity in SOFR. So we expect SOFR to be the gold standard going forward.
And what can firms do now in order to prepare for this?
So I think there has been a lot of transactions in 2018, both in derivatives and cash markets. So I think one of the things firms can do is really get ready for new products, issuance of new products related to SOFR. So get ready for derivatives trading, get ready for wholesale funding issuances in SOFR. Increasingly, we should see more transactions in the lending markets, so more sort of commercial loans, business loans, securitization products, and eventually consumer loans in SOFR as well. So really, product readiness, mobilize your program. There's expected to be a significant change for firms. So mobilize an enterprise-wide program and really get ready for reg scrutiny around the state of readiness around this.
Do you think there's going to be an impact to global financial markets with this transition?
We definitely think it's a major transformation, so there's a change impact for sure. We think it's a big shift from one reference rate to another reference rate, so we think there will be some impact around market liquidity, and market liquidity moves from LIBOR to SOFR. We think that's going to be another major impact. There's also going to be a lot of client education and counterparty education. I mean, this is a new rate, it's different from LIBOR, so there will be a need for a lot of client education, as well as legal repapering. There is a huge pile of existing contracts maturing post-2021 that are linked to LIBOR, and these will have to be potentially transitioned to SOFR. So there's significant sort of legal and repapering.
Right, and we see this in the fixed income market, actually any asset class. Yeah. Until liquidity begets liquidity, exactly. So until firms kind of get on board with the new standard, that's when you'll start to see liquidity get more robust.
Exactly. So, and we have started to see that in derivative markets, where we have started to see liquidity, but really what's going to drive liquidity is the cash products. I mean, the loans, the mortgages, etc. That's going to drive liquidity. One of the key dependencies for liquidity in the cash market is the availability of a term rate, and that's a problem that the ARC in the US is working very closely with FSB to really have this term rate defined, so that you could have greater liquidity and transition of the cash products.
When do you think this transition is going to be complete?
So the intended timeline is for a dependency on LIBOR to be reduced by the end of 2021. So I think that's the published sort of timeline. So all focuses on basically having a transition by the end of 2021.
All right. Thank you so much for joining us
Thank
at
you.
MarketSite.
Thank you for having me.
And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.